I am Mark Sebastian, the founder of OptionPit.com, and this is Options for Risk Management, the Option Pit Method. So a little about myself. If you don't know me, my name is Mark Sebastian. I was a floor trader for about 10 years. I then left the floor in, about now it's been a while. Wow, it's been almost 10 years. And I then started Option Pit because, I realized that there's nobody that really teaches the regular world how to trade like a true professional trader, and that's what we're going to do. So today what I want to do is I'm going to talk about risk management, money management, and a trading plan, and then ways I use options as like a risk mitigating tool, along with a few little tips and tricks here in terms of using things like puts and calls and collars to create a trade. So let's start with risk management. I wanted to kind of discuss risk management, and so I went on Merriam and looked it up, and they didn't have that as something I could actually look up. We had a risk manager in my fraternity. He was not very good at his job. We had, I had a risk manager at Group 1 when I was a floor trader. At my hedge fund that I run, we have a risk manager. Their job is to make sure I don't lose my shirt. So my definition for option traders, for investors, is taking risk in the most capital efficient manner as such to receive the highest possible return for the fewest amount of dollars. You want to put as little out there as possible and make the most. Pretty simple. But how do you do that? And that comes from structuring the trade properly, having good risk management, and efficient use of capital. Efficient use of capital is a key one. And a lot of people forget that. They don't think about, are they using their money in the best way? So that gets us to what I think is the most important part about risk management, and where I think most of the retail world fails. When I was getting my driver's license, I had to get a rules of the road. I had to do all sorts of simulating. I had to take classroom stuff. And then we get behind the car. Pilots, they spend like a year before they actually get behind the plane, learning how the plane works. Computer programmers do that type of stuff. Why do you, as a pilot, need to know the ins and outs of how the plane works? And I've got it there. It's so that when you're flying, you're prepared for what could happen and why it's happening. If you look through aviation and crashes, every single major crash. Now, the plane breaks a lot of times. There's something that breaks on the plane, but most of the time, when there is a major accident in an airplane, why does it happen? Why does a major accident happen on an airplane? Usually, if you look back, the plane has something that breaks that the pilots are unprepared for, and then it leads to pilot error. So they say pilot error, but usually it's something that causes the pilot to screw up, and then the pilot screws it up. That's the way most option traders are. Most option traders have pretty decent understanding, but of things, when things are working right, they know what they're doing. But when things are not, they don't. And when things break, they don't know what to do. And that's because they don't truly understand options. If you look at all the people that made miraculous landings, they all had extreme understanding of how the plane worked. Sully Sullenberger knew exactly how to glide a plane, how to make it land, how he wanted it to hit the Hudson. It wasn't like it didn't land by accident. It was an accident, but it didn't land successfully by accident. And that's where I think a lot of traders screw up. When things are going well, they think they're smart, they're winning on accident. And then they, when the S hits the F, they don't know what to do. There you have it. So where do you start with your understanding of options? Understanding the instrument is the basis of risk management. So how are options different from equity? How is one option position different from another? We always tell people we want you to learn the workings of an instrument intuitively. What does intuitive mean? What does intuitive mean? Intuitive means you don't have to think about it. Okay? So when I'm trading, there's a lot of stuff that I don't even have to think about. And that allows me to do well. So do you understand the basics of a quote, expiry, synthetics? This is where you start. Do you understand the basics of an option? The next piece is to understand the pricing model. Why do options prices change? Then, from there you move to the Greeks. And then finally, you have to understand non-modeled risk. All right? So there's such a thing as modeled risk and then non-modeled risk. There's one thing that people are good at is understanding when there's more risk than a computer would understand. That's what people are good at. People are good at understanding risk that you can't see. But in order to understand the risk that you can't see, you really need to understand the model itself and then watch how some stuff works for a while. Charts are nice, and so are risk graphs, but they're all built on models. If one doesn't understand how a model works, one can't accurately manage risk. You have to know what's going in. You ever heard the term garbage in, garbage out? You know, I know people that will just go right into trading rather than really learning the model. And that what they don't realize is you will actually get profitable faster not trading. You will get profitable faster not trading. It's annoying, but if you save the shortcuts, right? So like my son, he's learning arithmetic. And he already can do a lot of shortcuts in his head. He's a smart kid. But we make him do the calculations the long way. Why? So that he can truly and intuitively know the ins and outs of all the levels of arithmetic. All right, so if you understand the cause of risk, then you can manage risk. It's that simple. But in order to understand the cause of risk, you need to understand how models work, how options work intuitively. If you leave with one thing, here's what I would say. If you pick up the phone and call me and explain your position to me, I will, my mind, because I know this stuff so well, will be able to visualize what the position looks like. People that have been trading for a while can do that. People that really understand the model can do that, even if they haven't been trading a while. You know how much easier it is to trade successfully when you don't have to look at a risk chart? How many people here, just a quick, say yes, how many of you need that risk chart in order to trade? How many of you? Be honest. So I'm getting an overwhelming majority of yeses. So here's the problem, that model, if factors in the model change, your risk graph will change. Not the expiration graph, but the stuff inside the expiration graph will change. That is where traders get confused and they lose money. Does that sound familiar to anybody? Probably. So what I want, this graph is the SPX, and it's different P&L curves. So what I want you to notice is that volatility moving up is that blue, the red is the current, then you've got forward, so you know what date it is, and then you've got vol shock, down and up. And what do you notice? The curve changes. And then finally, understand the contract you're trading. You'd be surprised. What dollars are at risk? What's the multiplier? What does it expire into? What does it expire? When? So it sounds simple, except it's not. So let's just talk about the S&P 500. All right, I'm gonna list off the different types of options on the S&P 500. You can trade SPY, which is a $100 multiplier, and converts into the ETF and expires at the end of the day on Friday. You can trade SPX options, which are a 1,000 multiplier and expire in the morning. You can trade futures options, which maybe expire into futures and are a 50 multiplier. You can trade mini cash options. There's more too, probably. So you've got to be aware of what you're trading. Let's talk money management. This is also where traders screw up. They have too much money being thrown at something. That sound familiar? And this is the first thing you should be doing. How a money management plan. How many people here have a money management plan? You have $50,000 in an account. How are you going to allocate it? How much money are you going to put at risk? We use a term called VAR, value at risk. You need to have a money management plan. That's the very first thing you should do. All right, within my fund, we run trades that are high expectancy, but we put 10% at most at risk in those trades. People are like, well, what do you do with the other 90%? Well, if you lose 5, you know, we know that we can have some losing streaks. So we lose five trades in a row at 5%. We're down 25%. But we have a ton of cash. So we're able to continue to run a high probability trade. Sometimes people will screw up so bad you can almost hear them crying. What do you think happened? So we're at the 1-year anniversary. Somebody pointed this out today. We're at the 1-year anniversary of the XIV SPXY blow up. Why was it so bad? Why did that blow so many people up? Because they had poor money management. They had way too much dollars in SPXY. Well, it's not just that they were short vol. They had too much money that was short vol. People were putting a huge amount of their dollars at risk. You know what? A lot of people knew that could happen, that SPXY could blow up. What they didn't understand was that you don't put 25% of your account in there. You put 5, maybe 10. So now, here's what you need to talk about. Here's the steps of a money management plan. What kind of money do you have to work with? What is your goal rate of return? How can you allocate capital so that you are able to achieve that rate? Can this be done without a blow up? If you can't get this without this, it's a bad plan. Is the plan efficient? You know, one of the mistakes I think a lot of people make is people spend a lot of time thinking about their losers. What they need to do is spend more time looking at their winners. How many of you spend a decent amount of time examining your winners? Answer with a yes or a no. I'm seeing a lot of no's. What if I told you that you're losing more money on your winners than you're actually losing on your losers? What if I told you that? What do I mean by that, you think? What if your winners are all making 5%, but if you made a little change, you could make 10. And what if I told you that your losers were exactly as you expect? There was no way you would have lost less. Where are you actually losing money? Where are you getting beat? Are you getting beat on your wins or your losses? You're getting beat on your losses. That is where traders screw up constantly. At my fund, one thing we're constantly doing is asking ourselves, even as we're winning, is how can we do this better? How can we do this better? And that's where is the plan efficient comes into play. You need to check your efficiency constantly. Right now, and this is also important, does the plan scale? And this is something that I think traders fail to think about. You know, I'm a relatively young trader. I've got $30,000 and I'm trading it. Would I trade $30,000 the same way if it was $3 million? Would I trade $30,000 the same if it was $3 million? How many people here ask themselves that question? So now ask yourself, if you're not asking yourself that, you need to. Because if you wouldn't, you shouldn't. If you wouldn't, you shouldn't. So if you wouldn't trade $3 million the way you're trading 30,000, then you shouldn't trade 30,000 that way. That makes sense? Good. So now let's talk capital. Different accounts warrant different approaches to trading, but do not treat any capital lightly. This is another mistake traders do. They put money in an account and they think it's, it's funny money or it's a casino. All capital is part of building success and wealth. There's no such thing as throwaway capital. All right, and I'm sorry I keep saying this, but at my fund, do you think I've ever said, meh, it's $5,000, if I lose it, who cares? What do you think my clients would do if they heard me say that? And trust me, I'm trading some decent dough. What do you think my clients would tell me if they heard me say, man, it's 5,000, who cares? I don't care how rich you are. But believe me or not, it's amazing. I'll have a client nickel and dime me on our platinum class, and then they're not worried about losing. Yeah, they'd fire me. And then they're not worried about losing, $1,000 or $2,000 in their account. So here's what I want you to think about that dollars, those dollars that you're looking at in your account. I want you to look at it as that's actually something I could buy something with. Trust me, if I told Lauren, hey, I'm going to blow, Lauren's my wife. If I told her I'm going to blow $5,000, she would say, no, you're not. And she would take it from me. And she said, I will invest this in something I actually want. So I like to think about cars. It's only $5,000 in that account. That'll buy you a pretty sweet Mustang. Look at that Mustang. It's got an air scoop. It's got some nice wheels. Sure, it's got some miles on it, but who cares? Would you rather blow $5,000 or have that car? What do you think? So now let's talk about being realistic. Is 5% a month a realistic number? How many of you are going to make compounded 80% this year? Well, somebody just said, I'm really glad that I learned that you can get cars on eBay. Yeah, you can. I mean, even 2%, annualized is 26%. That's 2.5 times the historical return of the S&P 500. So be realistic. If you are on a webinar and someone's telling you that you're going to make 100% a year, they are lying. And believe me, I have clients that make 100% a year. I do. And I'm not saying that we haven't helped them. We've helped them a lot. But they are full-time trading, 100%, using portfolio margin and doing professional trades. So be realistic. Having the right expectations will stop you from doing stupid stuff. So let's talk about capital allocation. How much of an account should stay in cash? Minimum 50. Minimum. So now, if you're looking to get 80% return a year, you're now actually looking for 160% return on your traded capital. Think about that. And then how should you allocate your capital across your trade? Capital allocation is Huge. You need to have a VAR for every trade. Value at risk, VAR. Everyone learned a term today. So now let's talk about the risk of a blow-up. One common mistake is too much of a good thing. The SVXY approach. Diversify. Be aware of the risks of long-short premium. Be aware of your maximum loss in a catastrophe. And this is key. This is the key. Always be able to trade. And never be short units. That means you should, on the whole, be net long options, not short. You can be net short premium, but not net short options. Do we understand the difference there? Net short premium means I'm collecting decay. Net short options means I can blow out. Never be net short options, or units, as we like to call them. Is it scalable? And this is what I meant. If you wouldn't trade 200,000 like you trade 20,000, don't do it. Someone there's no trading in SPXY or options after the close when it imploded. Well, then traders should have had the proper amount of risk on given the scenario. So what's interesting, I find, is that your average retail trader takes risks that would have gotten me fired as a market maker. Every morning, I went through my sheets to make sure that I wasn't going to blow up. And I still had some blow-ups. The next is the trading plan as your nitty-gritty of a capital allocation. So it assumes all trades are tradable. Can I give you an example? Someone asked, can you give us an example of a blow-up? So the biggest cause of blow-ups are what we call gaps. So, for instance, we're recording this on January 31st. Facebook reported earnings and moved $20. At the time, it was a $150 stock. At the close, it was a $170 stock. I knew a trader that liked to sell out of the money strangles Yes, he is. Like to sell out of money strangles into earnings. Told me how smart he was, and then one day Apple moved like $30 or something crazy on an earnings, and I never heard from him again. I told him he was going to blow up, but he didn't listen. So, and I want to make, John, one key, and this is what a lot of mentors and educators teach, is throw capital at a bad trade. Don't do that. So you want to allocate capital to each trade in the plan, adjust the size of the trade according to how good the trade is, put into place restrictions, and cover adjustments and insurance if you're going to get insurance. allocate according to what trades are more or less favorable. Find the best trade. If butterflies are better, trade more of them. If condors don't look good, don't trade them. And cash is a position. It's fine to have. So now, what is the most important part of managing risk? The answer is picking good trades. Good trades make risk management easy. And if all you do is sell premium, you need to find a way to buy straddles and strangles. You need to learn a method. Real briefly, how many of you will buy straddles, strangles, calls, and puts? Or as opposed to just selling premium? How many people will buy? So here's what I'll say. At any given time, about you'll go on, you look on one of the internet TV shows, and they'll tell you how 80% of options end in being out of the money, unexercised. They expire worthless. Who's heard that? That's actually true. However, that doesn't take into account how in the money they are when they end up in the money. My friend Russell Rhodes, who's now at an options research firm, did a study when he was working at SIBO on earnings. And what he found was if you sold premium, if you sold straddles on every earning, you lost. If you bought straddles on every earning, you lost. Typically by the bid-ask spread. And what he found was earning straddles usually make money. But when they lose a lot. So there's no P&L in being short. If you're just blindly short, you're going to lose. If you're blindly long, you're going to lose. So what I like to say is that at any given time, about 50 to 60% of options are too expensive. 10, 20, 30% are fairly priced. 10, 20, 30% are too cheap. You need to spend the time to find the options that are too cheap and buy some of them. Protect yourself. Because what happens to stocks when the market tanks $50 or $80? Everything correlates. So your long straddles work. And you will not lose your shirt. Meanwhile, your butterflies and condors in normal markets will make money. Not such a stupid idea, is it? So what you want to do is write up optimal, normal, and no trade conditions for everything you trade. And then have a plan for adjustment. What if the underlying rallies and IV is down? What if the underlying rallies and IV is up? What if the underlying falls and IV is up? What if the underlying falls and IV is down? What if skew shifts? If you're not planning for this stuff, you're half-assing your trading. And that's your money. And if you don't want to do this stuff, fine. Give it to me. If you're an accredited investor and you're rich, whatever. So now, set max losses. Set a max loss and set an absolute max loss. And I love absolute max loss. I think it's a really great thing that traders need to use. And that is a loss that you will never let your trade get to under any reasonable scenario. For a condor, max loss might be the same as target profit. Absolute max loss might be the total cash equivalent. Don't go beyond max loss and adjust things when there is a max loss. So one of the hardest things for traders to deal with is when a trade is down but not at max loss, what do? They won't adjust overnight, and then they come in the next morning and the underlying is traded. So if absolute max loss is one or two standard deviations, you need to adjust. It'll save you money. And again, now adjusting, never throw capital at a trade. If the idea of adding butterflies and calendars as a solution is mind-numbingly stupid. Rolling and increasing size is even dumber. Throwing money at a trade is the way to turn a $10,000 loss into a $50,000 loss. Who here has been told to add trades to losers? I can promise you, people that tell you to add money to a trade are not actually trading. Because no one in their right mind would do that. Keep return targets and max loss off the original trade. Do not add in the adjustments. So let's say you're one of these mind-numbingly dumb people and you add risk. That doesn't mean you should add to your max loss. That's how people lose. And never open up a cheap option. Don't buy or sell a nickel option. And stay contract neutral. Always stay contract neutral. I say try here, but stay contract neutral. All right, so that kind of covers my, philosophical risk management approach. Hopefully you guys got something out of that. Does anybody have any questions about philosophical risk management? Or I go through a couple of pieces of covered calls and protective puts. Again, if you're not using covered calls, you're missing out. And you may be falling in love with the stock. I do a podcast called Option Block, and Mark was telling me he saw a 1-star review that literally said Mark Sebastian said something bad about Apple. Think about that. Don't fall in love with the stock. It's a stock. Don't fall in love with your house. Don't fall in love with any asset. I like my house a lot. But if somebody walked up to me and offered me market value for my house, I'd sell it. And then I'd move. Most houses sell below market and are bought above market. And the spread is picked up by real estate agents who are market makers. So what I like about covered calls is that it sets a level to get out. It produces income, sets a top for a long position, stays the trader. You don't have to make an out position. I don't know. I think I'd take market. Because I think I would be able to buy below market. Again, most houses sell below market. All right. So what I like about covered calls is that it'll get you out. Give away your stock. And if you're thinking about tax, then you've done well enough on the stock. Seriously. Here's a covered call position. This is Apple. This is a trade I kind of like. All right. Why? Well, Apple is $167. I can sell the 170 calls, which are 2% out of the money, and I can collect 2% of the value of the stock. This is on March 15th, so it has about 45 days to expire. I believe 43 to be exact. If I can make 4% on a stock in 43 days, you think I'm a happy camper? Let your stock get called away. This is what that risk position looks like. It's a great trade, a great position. On the covered calls, do you set the strike by the chart or based on valuation? I sell my calls based on where I have no problem giving away the stock. I also want to collect at least 1%. Now, let's talk about using puts. Puts can be used to set enter or exit point. Buying a put will set a floor. Over the life of the hedge, though, so I run a fund that is an SPX fund that has a real-time hedge. And what we do is we will actively hedge when it's worth it. Hedging all the time, it will lose a massive amount of dollars. So unless you have a crazy level that you are long from, and this happens to people that work for companies. People that have company stocks that they bought, 50% below market or got really cheap options and they exercised them and they were great, they should use puts. Other than that, don't use puts to hedge. Just dump your stock when it hits a level. And if it blows through a level, sell it. Puts, on the whole, are a preservation of wealth tool and terrible at wealth appreciation. I'm working with a client right now who owns a lot of stock, and he's setting up put positions. And I advised him, I'm like, I think that you'd be better off not doing this. And he said, I don't care. It's more important to me that at the end of the day, this is still worth $2 million than the X hundred thousands of dollars I'm giving up to hedge it. Unless you're in that scenario, don't hedge with puts. We do vol hedging here. So when the market starts to get scary, I'll buy calls on VXX, or I'll buy VXX itself. I'll buy VIX futures. Puts are more valuable for entry points. Sell puts in names you want to own, collect the premium, and then hopefully buy on the dip. Apple was amazing for this. The day Apple pre-warned, I wrote an article on the street. I'll show you this. Come on. There's that handsome devil. I said this was the ultimate put sale. Did not take delivery, but I said sell the July 145 put at $13.50. Why? I would take delivery at 132. I didn't care. Never. Someone asked when I'm going to update my picture. Never, because I'm handsome in that picture and I like it. This is but that's 10 years ago, though. I guess I should update it, huh? All right. But this is what a protected put looks like. What does a protected put actually look like? It looks like a call. If you are worried about your stock and you're thinking about a protected put, what you should do is dump it and buy a call. I do like collars, and I'm going to talk about that. This is what a put sale looks like. It's nice. You get to collect. I love puts to get into stocks. That is the only way I would ever buy an equity is by selling premium to get into it. So a collar is off in the professional world is called a risk reversal. And it's a combo of a protected put and a covered call. And it's great for traders with concentrated positions. If you have a concentrated position, by all means, if 80% of your wealth is in a stock, by all means, please hedge. It's a great risk-off trade. It can be set up strategically for just about any situation. So here's what a collar might look like. This is an Apple risk reversal. So what do I like about this risk reversal? One, if Apple drops below 160, I'm clean. If it runs above 170, I'm clean. But what did I do here? What is the net here? And this is key. What did I get here? I got a credit. Real nice. When I'm doing risk reversals, which I don't do very often, I'll be honest, but I don't own stocks for very long. But if I own a stock and I'm doing a risk reversal, I want to get paid on it. And that's a collar. You see, it looks like what we would call a call spread, but we're not going to get into that today. So in summary, understand options to understand risk. Charts can change. All capital is precious. Learn to use options for stock trading and use puts to enter, not exit. So what have we got going on? Doesn't start to September 30th. Sorry about that. So this on February 9th, so a week from Saturday. We are doing a 4-hour course on options for investors. If you want to be an investor, so if you own a bunch of stocks and you want to learn a way, if you own a bunch of stocks, you're leaving money on the table, even if you're doing covered calls. So what we're going to do in this class is teach you how to hedge, manage, protect, produce income on your stocks, and more importantly, We're going to teach you all the methods to never own a stock again and still be an investor. We're going to teach you how to use the Greek. We're going to teach you how to express investment decisions using options. We're going to teach you to invest for income with weekly and monthly options and manage risk like a professional. It's going to go in our store for $297. The live class is $197. I'm going to give you a $100 rebate when you buy it. So when you buy it, it's going to be $297. I'm going to rebate back $100. And if you use code 25_off by Friday, I'll take an extra $25 off. So what'll happen is when you go to risk class, it'll say $297. Use the code. It'll drop to $272. And then the next day, I'm going to put $100 back to you. We're going to teach it live on that Saturday. It's going to be 4 hours long, and you're going to learn a ton. Be taught by me and Andrew, who's my COO, who's kind of taught me how to trade. Single best thing you can do. Any questions about the class or what I just covered? Friday, tomorrow. If you hate the class, I'll give you your money back, John. I mean it. Any questions? I'll take extra questions now, but I'm going to stop the recording. Thank you so much for listening and paying attention and coming to my webinar. And thank you for the hour of your time.